normal accuracy is 90%.
How's it going, guys? Welcome to the Proven Ground Review. We're gonna get started here in a couple minutes. As you guys log in, let me know if you can see my screen and hear me talking. We've actually got a jump start on the conversation, but as you guys log in, just let me know that I'm loud and clear and you can see my screen. Right now, I've got my green chart up. Go ahead and finish your thought, Cameron.
So this is something I think was Matt Watts did at one of the
Symposiums,
where he talked about how you can get a bunch of losers in a row, but if you've got hard stops at 20 pips or so, you can get that one really good long one.
Yeah.
And it totally resets everything.
Mm-hmm. Well, it shouldn't, because you should be using a smaller lot size per trade. You're right, it could, because if it was large enough, then it could bring you back to square or above.
It doesn't necessarily have to be super high.
You're absolutely right. It doesn't. Your win-loss ratio just has to be in line. So if you're using, let's say a 0.5 lot size, and you're increasing or decreasing for every 100, and you take 220 pip losers at a 0.5 lot size, that's a couple $100, right? So that means that now you're at a 0.3 lot size. You went from 0.4 then to a 0.3. So you take another couple, now you're 0.2, 0.1, right? Now you're at, let's just say, a 0.1. To that argument, you've got 4 trades. As you guys log in, let me know if you can see my screen and hear me talking. So now you've got 4 trades that you've lost, and that has decreased your lot size from 0.5 to 0.1. Now you take 100 pip gain at a 0.1, right? So now you've got a dollar. What is a 0.1? A dollar pip, and you got $100, right? But on the other side, you've already lost, what is that, 400? So you're still behind 300, even though you've only taken, 80 pip loss versus 100 pip gain. You have to decrease your lot size. Otherwise, what you'll find is that the math will catch up to you and beat you down, right?
Yeah.
If you just keep on pressing and keeping your lot size the same, or feeling like, well, I'm already at a 0.1 lot size, so I'm safe, right? Which is false, because if your drawdown is far enough, your risk to reward doesn't make sense. You probably shouldn't even be in a trade for a 0.1 lot size. But if you've got a hard stop, if your systematic, so to speak, approach says, okay, I'm always just going to use a 20 pip, which, by the way, is like that, like, it's perfect. It's perfect for a number of reasons. 20 pips stop loss, or within 20 pips, 20 pips or less, let's say, is absolutely perfect. Because anything beyond that, let's face it, if you're going 20 pips or more against your original position, chances are you called it wrong, right? So it's already over. Now you're just hoping and praying that it comes through, right? So those that use more discretionary approach, you hear Dale say a lot, I don't use stop losses. Well, he doesn't have to, because he understands his method of trading. I think it's reckless to say that, because then other people are like, well, if Dale doesn't use stop losses, neither am I, right? And that's stupid. Dale's not stupid. We know he's a good trader, but not using an exit method is stupid. And we're not stupid. So, right, yeah, it doesn't. So in one regard, it does, in the sense that he doesn't use a stop loss in the sense that he doesn't hard code a stop loss. But when the time comes, he either stops or hedges the trade. So he has an exit method, but it just doesn't involve hard coding a stop loss. It involves him pressing the button when it's time to and exiting that trade. Not everybody has the ability to do that, because we have jobs. Like Cameron says, I'm not going to sit around and wait for a trade. I'm going to do my long-term analysis. I'm going to set it. I'm going to go about my business and forget it. And when I come back, it will either won or lost. Now he's back tested, because I know Cameron, and Cameron is great at back testing. So he knows this is what its result is going to be, based on historical back testing. And if I know Cameron as well as I think I do, it's not just for a couple months or even a year. I would say he probably back tested it for at least 2 to 3 years. 5, there you go. So I undershot Mr. Diewert here. So they're, point taken, right? You can only get to that level where you can set and forget and be confident enough with your approach that if it hits a loser, it's all right, because it just gets you that much closer to a winner. So taking this long-term versus short-term approach is not as simple as people may think it is. When you first start, we've talked about this recently, it's imperative that you have something that's systematic. So systematic just means you've got these rules, right? For me, when I started, it was double crosses. When the majors and minors are overbought and they cross down on the same candle and they remain that way until the end of the candle, sell. Or oversold and they cross up together on the candle and wait till the end of the candle and buy. So then the question was, well, for how many pips, right? So I was watching the audits and it seemed like the magic number was always 10 pips. What do we take on the audit? 10 pips, right? You take the AIT, most of the time it's 10 pips. Everything's just 10 pips, right? So naturally, you think, well, if I see a double cross, it should be good for 10 pips. No, it's not. It's not as accurate as we hoped. But it's through back testing and front testing and hard knock and demo counts, burnt demo counts. You realize that that's not the case. So you're just now kind of unraveling, and hopefully that's not where you start. Hopefully you realize before that point that there's this whole money management exit strategy facet to the game. Otherwise, you've already started on the wrong foot because you're putting the cart before the horse. Let's assume all things being equal that you've already identified that there is this facet of exit, right? And money management and proper exit strategy. So then you look at a double cross, and for the times that you trade, you realize, you know what, it's not consistent. And when it is, it's not for 10 pips. What else is in front of me that I could utilize in order to make this work? So I instituted, for me, was pressure. I just needed pressure in my favor. Well, when I learned about pressure indicator, it was different than what you guys first learned about pressure indicator. So what I learned was more of a nuanced approach to pressure, which is why look, this is like my baby. Okay. So it's not mine. I didn't create it, but it's mine. I just kind of adopted it. Now it's mine. Right. So I get offended when people say and refer to things the way, and that's, it's not accurate. Right. So when people call pressure indicator a trend indicator, pisses me off. Most of the time, well, I was going to say most of the time I'm nice about it, but I'm usually not nice about it. So who am I kidding? But it's not, and it kind of cheapens it. I remember Kevin. I'm on. There it goes. Thank you. I remember Kevin when I first started trading. I sat in on the light session wherever they're doing it now. Longer than I probably should have. I was already an advanced member. I was already out of coaching. I was already trading the live money. And I was still sitting in the light meeting because Kevin Jones was teaching it. And after a while, he's like, Hiram, you can't come to this one anymore. You got to go downstairs next week. Anyway, but at the time, there was like 2 people in the room, right? It was me and some random person. It was always me, but some random person. And the random person never asked questions. So I'm like, this is like a one-on-one. I'm good. I might already need to go anywhere else. So with Jones, he used to do this, and this is actually something I do in the mastermind as well. So it's not anything I created, nor would I ever take credit for it, but he would peel back all the indicators except for the pressure and no candlesticks, just pressure indicator. That's it. And if you guys watch the mastermind session, I think it's in the 40s. It's just called pressure indicator. We do the same thing. We peel everything back on a 60-minute chart. All we have is pressure. No candlesticks, no TNTs, no major minor, just pressure. And we look for something really specific in pressure. And we make lines every time we see that specific thing in pressure. And this is kind of the lead in for me, right? And it's foundation. And that was green pops on top of red, and they both point up. So after a while, we grew out of that. We started realizing, okay, green popping on top of red, there's usually some type of reaction to the market. Do we have another indication that would give us credence to take a trade in that direction? So that's kind of what birthed dirty pressure, right? Which is green just pops on top, major minor pointed up, you buy. Doesn't matter where they are, overbought, oversold. Doesn't matter if they crossed 5 candles ago, as long as all 4 lines are pointed up and green has just popped on top of red. And then green popping on bottom of red, same thing. We just want major minor to point down. Doesn't matter if they're overbought, oversold in the channel. Doesn't matter how long ago they crossed, as long as they're just pointed in that general direction. So you realize really quickly that you can see not only when the change happens, but you can almost predict the change coming in the pressure indicator. And when you're able to do that, you start noticing these small nuances and just the bends of the lines and when they're likely to cross. And be familiar enough with some of the other indicators to be able to predict. And we were talking about this before the session, and that was that there's a condensation that you can't pick tops and bottoms. You can't pick the very bottom of a trade or the very top of a trade and ride it the opposite direction. False. You absolutely can. You absolutely can. And I've done it for years now. I just only want 10 pips out of it. You guys probably want the whole 150. I don't care. I want 10. And when I pick the very bottom or the very top, I'm out in seconds, and I'm happy as can be. You guys can take the rest. I don't care. I'm done. Yes, sir.
So can you tell where it's going to end? Can you tell where it's going to start?
You can, yes, pretty consistently, actually. If all I had was major, minor, and pressure, I could pick tops and bottoms. Just major, minor. I don't even need candlesticks. All I need are major, minor, and pressure, and I can pick tops and bottoms. Because there are things that the indicators do naturally. Okay, let me give you an example. Right here. How many times, see how straight these lines are on the 60-minute? Let's look at just a 60-minute. How many times do you see these lines straight like this, go on to the next candle and remain straight just like that? Never. Never, right? Do I have any objections? Okay, so right there you realize what is already unnatural about the major minor. What usually happens to the minor after they get a little high up? They start to fatigue, right? Yeah, they start to create a hiccup, right? So if you know what's coming to a certain degree, then you know, okay, what to expect based on how they got there and what they may very well look like. So now you're taking a predictive indicator and predicting how it's going to look, right? You want to be careful with this because if you get it wrong, you're going to, you'll learn really quickly. So don't be careful. Just go ham. But you can generally get a consensus as to what's natural and what's unnatural about the indicators after a while, if you're paying attention, right? So one of my frustrations was I was always told, well, wait for them to be overbought and then cross together, pointed down, and sometimes not even enter the channel or enter the channel. There has been debate on both directions over the course of years. Why? Because what they are today are different than what they were when I first started trading, which is why the argument always persists. In order to determine what it should look like and how it's going to be useful for you, you have to back test it, because what it looks like today may not be what it's always going to look like because the market conditions change. So you want to make sure that however you're approaching the market right now is going to be something that has longevity. The only way to figure that out is to back test it. There's no shortcuts. All right, so if we know that this is common, and we can go back and we can look at, so let's look at another example. Straight lines, minors have already partially entered. What's the likelihood that these lines are going to be straight on the next candle? Not very likely, right? What do we expect to see? Usually fatigue on the minors and maybe some bending in the majors. No bending in the majors, very slight bending in the majors, but there's a fatigue on the minors. So we kind of got a good understanding of what's going to happen, what they're going to look like next. Now, how powerful would it be if you knew what you were going to do if it looked like that next, right? So then you start looking at a predictive indicator predictively. So now you're like telling the future, right? You got this crystal ball. Not really. Anyway, even in that, you're going to lose. Trust me. Anyway, so when talking about picking tops and bottoms and going the opposite direction, that takes a lot more than, at first, a lot more than just the indicators, because to see them that way it's much more nuanced, right? So there's a million different ways to look at the pressure indicator. Some people want to look at it very simply, which is great. That's where we want you to be if you can't see it beyond that, which is pointed up means don't be shy, buy, right? Pointed down means sell, simple, right? Okay, green on top, pointed up, buy, green on bottom, pointed down, stronger buy, stronger sell, right? Or green just arriving overbought, which is positive convergence, pointed up, that's a really strong buy and more longevity, 1 to 3, maybe even up to 7 candles. And the opposite, green just popping on bottom, pointed down sharply, positive convergence, that's going to last for more candles, right? And then taking that to other time frames and understanding how they work on other time frames as well. Understanding that if green popped on top or was already on top and is now starting to converge into red and possibly popping on bottom, then you're likely to see some softening in that direction. So you're not putting too much credence into the buy anymore. On the contrary, you probably look for some retracement first before you continue to buy, right? So if you're looking for, say, the top of a retracement trade, and you see that green is starting to lean into red perhaps, and major minor have been overbought and likely going to roll and perhaps double cross short, your entry may very well be after the double cross short. Well, when the double cross happens, why did that happen? What did the candle do? It already shorted, right? So if you're in a downtrend, great, because then you can catch the rest of that and continue to short. But what if you can catch it before it double crosses, because you know that it's going to double cross, because you have other indications that it's going to happen. So now you're using trend, you're using what is seemingly natural and unnatural for the indicators to do. You're using minor nuances within the pressure indicator, longer and shorter term time frames to position correctly, and you're catching the very tops or the very bottoms of either retracement or full turnarounds in trend, right? So that's somewhat relevant to what we were going to talk about today, which is just long-term versus short-term. And I actually had a spreadsheet where I compared some of the more popular long-term trades to some of the just systematic approaches. So what I did essentially is I took a couple of the coaches' long-term approaches, including some of my own, like the duckbill and things like that. And I looked from a 3-month period, which was like October to December, for all of October, all of November, all of December. And in that time, I found about, oh man, I wish I had my spreadsheet. It was about, what was it? 15, I want to say there's 15 different examples of where I could have taken a longer term trade in that time, right? Which is roughly 2 a week, right? If I'm thinking back, actually it's probably a little more, almost 3 a week, right? It's 4 weeks in a month, 3 months, it's 12. If we had 1 a week, 15. So no, almost, yeah, it's almost 2 a week. Let's just assume 2 instances where you could go for more than 20 pips. In just about every one of these instances, you could likely call a 50 pip trade pretty consistently. And then everything after that is kind of cross your fingers and hope that it goes for more, trail the trade, right? But you can't really say, with this approach, I get 100 pips, right? You say, with this approach, I get at least this many, and then I trail the rest to get 100. Right. And that's good because some people are really good at that. And the way you get really good at that is to make sure that the opposite end is not so large, meaning your drawdown, right? Because there's a million arguments that could be said about, okay, well, if I just let it draw more and then eventually it comes back, right? Because the market always comes back. I'm making, what are these called? The quote symbols for those of you guys that are online. The market doesn't always come back. Then, I can get tons of pips out of that. Well, that's not mathematically sound, and you're never going to make profit that way. But let's look at that for a second. So 15 examples of where the market didn't draw more than 50 and would have given us our profit. So I did it a couple of ways. I said, in one instance, we'll trail it, right? And if we trail this trade, this is the maximum amount of pips that we could have gotten based on a trail that was based on support and resistance, right? Which is, of course, my opinion. So there, give or take, some people could have gotten more, others perhaps less. But that was pretty consistent in terms of how to trail it. And the other one was just going for a set amount of pips and a set amount of drawdown. And the third was trailing it, but after 20 pips, releasing 50% of the profit and letting the rest run with a 1 pip stop, which is the most common approach in trailing a trade. So that means that if I put in a buy trade and the market goes 20 pips and it posts 20 pips beyond where I entered, and I'm at a 1.00 lot size, then at that post, if it's 20 or 25 or whatever, the first candle to post at or above 20 pips away from my original position, then I release half my lots. So I go into that trade and I close 0.5 lots out of that trade. You guys know you can do that? You can close partial. So you can close part of a trade, not close the whole thing. It's actually a really good way to whittle. We won't talk about whittle tonight, but that's cool. We'll have to do that sometime. But now I'm only holding half of my original trade to trail, right? And now I have a stop profit at 1 pip. So if the market does come back, well, I made 20 pips at a half lot and 1 pip at a half lot. So I'd make 21 pips, but I'm guaranteed 21 pips at that point. Guaranteed, lock, stock, and barrel, right? Okay. If it keeps on going, I can continue to trail that half lot, but I've already secured profit, and now I'm just trailing the rest. So it's like you go to a casino and you win a little bit, you put your profit in your pocket, and you play with your winnings, right? Or you put your capital in your pocket, you play with your winnings. It's kind of the same concept. So now I'm trailing this. So I looked at it all 3 ways. Now here's one thing you can't do. You can't decide which one of those approaches you're going to take after the fact, right? Either you stop your trade, you trail it a certain way, or you close out 20 or 50% of your profit at 20 pips, so on. So you got to pick one or the other. You can't do all 3, right? Because the decision is made after the trade is done. So what I did is I gave the situation the benefit of the doubt after the fact. I decided which one would have been most profitable, and I assigned that pip value. And then the next trade, I had now a new balance, and so I used that balance to determine what my lot size would have been on that next trade. Now all these were based on a reasonable amount of stop loss, and that was based again on support and resistance not exceeding 50 pips. So that means that there was not one trade in this sequence that exceeded a 50 pip stop loss. Some of them were 30 something. The least I think was like 25. None of them were below 25. All of them were about 25 to 50, right, respectively. And I was looking at this not based on how I would stop it or hedge it, but how, say, somebody who's been here for a year would do it, right? Because that's fair, right? Because those are the people that are looking for the difference between a short and long-term approach. So a couple of things about this particular approach is you got to question your motive as to why you want to take longer-term trades. For Cameron, for example, I know Cameron, so I can speak to this, and correct me if I'm wrong, Cameron, because we just literally had the conversation. I actually alluded to it earlier. For Cameron, it's that, look, there's time constraints. So I want to be able to look at a longer-term chart. I want to be able to say, okay, relative to the amount of pips that I know I can get, I'm going to use this particular stop loss, whatever it may be, based on back testing for 5 years. You said, right? 5 years. I know that this is the stop loss that I can use to get these types of gains. And so I'm going to set the trade based on my parameters, and I'm going to use a take profit and stop loss, not a hedge, and I'm going to walk away from it because I got to go do other stuff, right? And when I come back, it either won or it lost. But long term, it's going to win me profit. So who cares if it loses? Who cares? As long as it makes me profit, I'm good. And this is working really well for him. Matter of fact, he's like a phoenix, that rose from the ashes, because he did have a hard run at first, and he figured out, okay, this is what I understand. I'm going to back test these concepts to see what I come out with. And I'll tell you, man, I've got more back testing data from Cameron than anybody ever. Seriously. I mean, just crazy back testing. So he says, okay, finally, I figured out my secret sauce. Now I'm going to implement it. And he's doing really well with it. So his motive is different than most. And the reason I say most is because if you go online, if you go anywhere else, long-term trades is a necessity. It's not a choice. It is an absolute imperative necessity to survive in trading. That's why you've got all this rhetoric, right? It says, cut your losses, let your profits run, all this stuff that you hear that the world, the trading community of the world speak, right? And that's because on average, the average win rate, in day trading, can anybody tell me what the average win rate is? It's 50 to 55%. 50 to 55% win rate. So that means they have to use reverse ratios. If you get really good, then your stops are really small and your gains are huge, right? And some of the most successful traders in the world have crappy below 50% win rates, but their drawdown is like 5 pips for a 50 pip trade, right? Because they've figured it out. It's taken them years, burned accounts, so on and so forth, but they figured it out. Good on them. Do they need my system? Nope, they don't. But would they have taken it if they had the choice before spending years burning accounts and losing? Absolutely. I've asked them personally. It's always the question I ask them, and it's unanimously always the same. Absolutely. But I'm good now. I don't need it anymore. Good for you. Just curious, right? So here you find yourself in a situation that traders that are successful and multimillionaires would have killed for when they first started. And it's kind of silver spoon because I think sometimes it's taken for granted, right? So if I could figure out money management exit strategy early on, then I'm good. I'm going to be able to make profit. How fast I make that profit is going to be relative to my ability to read the market more aggressively, right? But as long as I understand money management exit strategy, I will be successful in the market, hands down, bar none. Doesn't matter what you use. You could not use our indicators and be successful. Take you a really long time. Do the math. I don't have to do it for you. Do the math. It'll take you a really long time. The higher your win rate, the better your ability to protect your trades and manage your account, the faster you're going to get there. So we're talking about, 12, 18, 24 months versus 5, 6, 10 years. Literally, that's the difference. So if we took this longer term approach and we said, okay, we had 15 different instances where we could have executed. And because of our drawdown, we had to decrease our lot size. So I think the average lot size that I used on a $2,000 account, right? Because we're going to go super small, right? 2K was 0.4. No, let me think about this. 0.04. It was like 40 cents. 40 cents per pip. 0.04 to justify like a 50 pip drawdown at like 80%. Is that math right?
I think so.
Okay. For a $2,000 account, 0.04. So if you hit a successful trade, which by the way, I was hitting, I think I had 179 pip winner in there. And the rest were probably an average of, I'd say 30 pips. So I wasn't hitting 50 consistently. I maybe had 150 pip winner in there. 179, I think, was the biggest one. Never hit 100. Well, I only looked for 3 months. It traded at 0.4. When you include the losers, I think after all was said and done, I made a couple $100. So it was like $2,200 after 3 months, which is awesome, right? Because that's like a 20% or 10% growth after 3 months, right? People will kill for a 10% growth in a 401k for 12 months, right? So it's like $2,200. And then I looked at one that we've been talking about. Now, mind you, to do this, again, after the fact, I decided which approach I would have used, the trail or the take profit after 20 pips and let the rest run, so on and so forth. And after that, I said, okay, this is the larger number. I'll apply that number. Okay, what's my new lot size? So the lot size only changed, I think, once to 0.05, which was 50 cents a pip. Now, a couple $100. I used the same approach or the same time frame, October 2018 to December 2018. So if you guys are curious about this, go back to that time frame. I'm not just making stuff up here. And I actually have a spreadsheet. I just didn't email it to myself so I could show you guys. So I did the same thing, which is dirty pressure, because it's something that we've been talking about most recently. It's common. It happens really often. And I gave it the same win rate as these longer term approaches. And we just said 80%, which, by the way, dirty pressure in that time frame actually performed closer to 85%. And I actually have reports of guys trading from, so if you guys want to know, in 2018, dirty pressure for 13, 14, and 1500 UTC and 3, 4, and 5, so 03, 04, 0500 UTC was 93.8% accurate for a 5 pip trade with a 15 pip stop for those times. Somebody back tested it. They're like, this is the times that I trade. I just finished 2018. I'm working on 2017 now. And he hit 93.8%. David, if you're on, verify that for me. But 93.8% win rate for all of 2018 for 1300, 1400, and 1500 and 03, 04, and 05 UTC time. So I used just that, and I found that you could find on Euro US, GBP, JPY, and GBP USD at least 5 a day that you could take. So I looked at just the popular times of trading, right, which is like 6 a.m. Mountain Standard Time to 7 p.m. Mountain Standard Time. And I took just those examples. And I found that you could get at least 2 of those a day. So I looked at just those times and pulled out the two and just took the winners with the losers. So it actually performed really well for those time frames. And I ended up with at least 2 a day that I could justifiably say were actually there. Winners with losers. And because I was only using a 15 pip stop, that means that my lot size was larger. So my lot size for a 2K was actually closer to like 0.2. That's not right. It's like 0.1 and some change. Let's just say 0.15. So I think it was either more or about that. So this is about $1.50 per pip, right? Versus 40 cents per pip. So I was able to compound this much quicker. I think after the first month, I had already been able to increase at least once. And then I realized that I didn't have enough losers because it performed at a greater than 80%. So I sprinkled in some losers randomly, but I did them very like unjustifiably. Right where I had a lot size increase, I added the loser, right? So the trade before that was like 0.15. And then this trade was 0.17, and I made that a loser, right? So then the next trade was back to a 0.15, and then shortly thereafter it went back up to a 0.17, so on and so forth. And I did that like twice, and then I put concurrent losers in there, which didn't exist. So I had a loser and then winners for days and then another loser. So instead I said, okay, loser, I'm just going to sprinkle in a loser right there, right after that other one. So I had like 3 instances where you have concurrent losers, and I've got this. I'll put it on Slack as soon as we're done here. And then at the very end, I realized, well, I'm still not at 80%. I need to add another loser in here, a couple losers. So I had 3 concurrent losers. I had loser, which was justifiably there. Then I added 2 more. So I was very unfair to this example and very like forgiving in this example and in the long-term example. Now, when you did the math, I actually would have increased by about 500 and some change on the short-term approach, just taking 2 5-pip trades a day versus a longer-term trade. In this particular instance, it worked out because my stops were a little more outlandish than, say, something like Cameron would have, right? Because that's where people start. They need that longer draw in order to get the bigger result. You need to be able to let it breathe and then hope that the other side works out for you. So in order to make this right, I actually had to add 5 100 pip trades at the same lot size, then compounded for the additional profit where necessary in order to equal what I would have made with the shorter term approach, right? And then so what I did is I took the perfect scenario and I said, well, what if all of these hit just 50 pips, all 15 of them, right? And never had a loser in all that time. And they hit 50 pips every single time. I actually would have gotten $500 more than my short-term approach. If everything was perfect, it would have doubled. Is it ever perfect? No, right? In this other scenario, I was super lenient. Plus, I added 5 additional 50 pip, maybe 100 pip trades. It was somewhere in there, and then compounded it accordingly. And that is what it took to catch up to the shorter-term approach, right? Which was just 2 5-pip trades a day. So again, what is your motive? Is your motive to get more pips or is it to get more profit? Well, it should always be to get more profit, first of all. Are you able to achieve that? And if you are, how long is it going to last? So the guys that are doing longer term approaches, they've put the time, effort, and energy into figuring out what that means for them long term, not just long term in terms of the trade, but long term in terms of years, right? Can I do this for years to come, or is it something that's just a parlor trick that works right now, right? It's so funny to watch history repeat itself with the market and with traders, because right now we've had, and this is why people have freaked out in 2016, here in 2018, and early 2015, was because since 2008, after like 2011, 2012, after those like 14, 15, part of 15, 16 was a little rough, 17 was much better, 18 was rough. We had these major corrections in the futures market. Well, everyone was kind of subscribing to the same thing they were subscribing to leading up to 2007 and 8, which was when the market drops, buy into the drop. That's your whole approach. That's it. Just wait for it to drop and then buy. Wait for it to drop and then buy. Because all it did was that, right? All it did was went up consistently. And it was easy and it was simple until one day it didn't. And so what did they do? It dropped, and they said, okay, well, what do we do here? We buy. And they bought, and it dropped again. They're like, well, that didn't work, but now it absolutely has to, because for the last 10 years, so I'm going to double down right here, right? Because now this is like bet the farm. This never happens. And whenever it does, it shoots up. So now I'm doubling down. I'm going to buy, and I'll be able to make up on this trade and surpass that trade. And I'm going to get filthy rich on this one, right? And then it kept on going further. And I literally, if you talk to Jerome King, he was on a webinar at that time in 2008 and somewhere in that range, right? And he'll have to tell you, but he was on with this well-respected, known guy, $1 million, multi-million-dollar account. He's trading in the live market in this trade room that he charged $250 for people to join and take trades with him, right? And this is that, whole concept, audit concept that we were talking about earlier. It's like when you rely on somebody to feed you, when you get what you get, right? So he literally watched as this guy kept on buying into the short, and the guy burned his whole account, multi-million-dollar account, right in front of him, right before their eyes. And then he cut the feed, and no one ever heard from him again. Just cut the feed and dropped off the face of the earth. Burned his live account in front, and you'd be surprised at how many people that happened to. So how do you know that you're not in 2008? Well, first of all, you probably are, because a recession happens, every 10 years, 7 to 10 years, right? Okay, when was our last one? 2008. What are we in now? 2019. We just finished 2018, which is how many years? 10 years, right? So everyone's going to blame it on president or on this guy or that guy or on Russia, on whoever. Listen, it's just history repeating itself. This is what always happens. 7 to 10 years, you get a recession, right? And everyone's like, oh my God, another recession? Well, yeah, that's what happens. Right? It's not like this shocking, it shouldn't be a surprising thing. For smart investors, what they say is, I'm going to nest egg for the next, 3 years while things are good, right? And then when the recession happens, there's blood in the streets. What do you do when there's blood in the streets? You buy real estate, specifically. Right? So that's it's the same concept of trading, right? I mean, if you're going to buy the lows and sell the highs, well, it's the same thing, right? It's a long-term approach. So you wait for the lulls. You just got to know when that lull is going to result in the reversal. So if you can do that accurately and consistently, then you've got yourself a long-term approach, right? And if you're doing that because that's what fits your risk appetite, not your greed appetite, your risk appetite, then you're on the right track. If it's for greed because you think you're going to get rich faster, you're going to get poor faster than you think. You've got to approach it correctly. You got to really consider your motives and your capability. Are you capable of calling a 50 pip trade? First of all, are you capable of calling a 10 pip trade? And when you call a 10 pip trade, does it go 30, 40, 50 pips? Is there something in what you're seeing in the indicators that are implying that you could get that? By saying, well, right now I'm using a 60-minute chart, and that's getting me 10 pips. So ipso facto, if I use a 240-minute, well, I'll be able to get 4 times that amount. False. The 240 doesn't work like the 60. Right? If you guys don't know that yet, it's okay, because now you do, right? It just doesn't. There's a lot of other factors going in 240 that are not present in the 60-minute, like announcements, right? So you can't really use that line of thinking. And if you really think about it, the majors and minors aren't going to play the same on a 60-minute as they do on a 240-minute or on a one-day chart. They're just not. Right? How many times do we see the perfect one-day chart pointed up, and we go to the next day and there's a big red candle, right? What we fail to see is that shadow that was for 85 pips, right? So how do we position in that shadow, or how do we take the 85 pips? Who cares what it does after that? Because a lot of times that big movement was a result of announcements or something that we're not even playing during. So then it gets you to think, well, maybe I should play during announcements, right? That's right. That's why you need multiple time charts. Absolutely. But in addition to that, when all the rhetoric around you, because 99.9% of traders out there have a small win rate, so that means that they need the large gains and they need the small drawdown, which is why 85% of day traders fail. 85% of day traders fail. Look it up. Matter of fact, it might even be larger than that. 85% of day traders fail. They never get to be professional. And it's because they don't understand some of those core concepts. The difference is always education. When is it not? When is it ever different than that, right? It always comes down to education. Those that are educated correctly become successful in the market. So what does that consist of? Well, Money management exit strategy, hands down, bar none. Go wherever you want, do whatever you want, use whatever you want. As long as you adhere to money management exit strategy, you will be successful, period. Hands down, bar none. It's just math. It's just the way it works out. You got to figure out how consistent your approach is. Once you've figured that out, you can apply a correct ratio, and then you execute. It's that simple. Dirty pressure. We know that from January 2018 to current, which is not enough data, by the way. You want to go all the way to 2015, but let's just say hypothetically we did. And we found that it was 93.8% for 1,300, 1,400, 1,500, 300, 400, and 500 hours on UTC. Any of those start times with dirty pressure is going to result in 93.8% accuracy. That means that you could use up to a 4-to-1. I wouldn't recommend it, but you can use up to a 4-to-1. Now that was tested with a 3-to-1. That means 15 pip stop loss, 5 pip take profit. To justify that, all you need is anywhere from roughly 82 to 85%, and you're getting 90. That's going to get you there quicker, much quicker, significantly quicker, especially if you can take 2 of those a day at a 90% win rate, 93.8, almost a 94% win rate. Do the math. How 9.4 out of 10 trades successful and 0.6 losers at a 15 pip stop loss, which means roughly an 8 pip loss out of every 10 trades. So if you're making 5 pips per trade for 10 trades, that's 50, right? So let's back that off a little bit. What is that, 49.4? Let's just say 50 pips minus 8. What's your profit? 42 pips. So every 10 trades, you're making 42 pips. Every 10 trades. And if you're taking 2 a day, how long does it take you to take 10 trades? 5 days, right? Okay. So 40 pips every 5 days, right? If you can hit 40 pips every 5 days and compound that, right? What does that equal if you spread that out? That's like, what is that? Like 6.3, something like that, pips a day. If those 6.3 pips was worth even 1%, every 4 to 5.5 months, you're doubling an account. Do the math. Every 4 to 5.5 months at what? Just a 1% increase, if that's all you did. So that means that if you have a $2,000 account today, and let's just say 5 months, you got a 4,000. 5 months from there, you got an 8,000, 16, 32, so on and so forth and so on. So if you back test and you found that whatever your approach was X amount accurate over a significant amount of scientific data, then you know that you can apply a certain ratio. And you have to figure out what that ratio is. You don't have to figure out how to back test it. Listen, the whole map is already there. We've talked about this, right? So take your long-term approach and figure it out long-term. How is this going to work? How can I project how this is going to work in the future? Is 2019 going to be like 2018? No, I can almost guarantee it. 2018 was bonkers. Are you kidding me? Look at all the geopolitical stuff. We sat down with North Korea. When's the last time that happened? Right? We just negotiated. We're still in the process of, right? And we kind of all figured that. But we were at the negotiating table with China. When's the last time that happened? Right? We had a disarmament. We had just tons of stuff that we haven't seen for decades in the market. And you think, well, what does it have to do with Forex? Everything. How many times have we seen something geopolitically affect the Forex market on a daily basis? It has nothing to do with the currencies. But all those things affect the Forex market, right? So how is 2019 going to be different than 2018? Significantly, vastly, right? Just look at 2016. 2016 was significantly different for the previous 8 years because we hadn't had a rate increase in the Forex market for 8 previous years. We were less than 0.25% for those 8 years until 2016. Then we had a rate increase. How many of you guys have been here since before 2016? Suffices to say that you have no idea what tomorrow is going to bring in the market, right? You don't know what the market conditions are. How many of your approaches have you guys back tested or been around and trading long enough to know that your approach has worked for the last 2 years? Well, I know you, Cameron. Good. 3. What about last 3 years? You can raise your hand, Cameron. So if you go to January 2015 to current, just go and look at it. Go and see that from January 2015 to current, just about any market condition that could have happened in that time frame. What do we call that? What do we call that time frame? The proving ground. The proving ground. You use that time frame to prove out whatever your method is. So run your process through the proving ground for the times that you trade. If you only trade at 7 a.m. Mountain Standard Time or 9 a.m. Eastern, whatever it may be, go back to 9 a.m. every day from that time current, or at least 2 to 3 times for every month between then and now. Get at least 100 examples from January 2015 to current, at least 2 to 3 a month, and figure out what the win rate would be based on how you approach it. If it's a 50 pip take profit and a 30 pip stop loss, how accurate is that? I mean, you've got tons of breathing room there. Imagine if you could get an approach that has a 20 pip stop loss and a 50 pip take profit, and you can call it consistently. Let's say you can only call it 60% of the time. Okay, so out of 10 trades, you're getting 50 pips. Who can do the math? It's 300. 3 losers, 20 pip stop loss. 60. What's the gross? Is that a winning? Who cares about 60%? So who cares if all you got is a 60% win rate? At that point, it doesn't matter, right? Because you've mitigated your losers. Your gains are much larger than your losers, and it's consistent. But if you're saying, well, I'm shooting for 50, I don't really know how I'm going to get there, so I'm going to trail it. Is that going to be consistent? No, it's not. You're going to get this all across the board. You're never going to have – I can tell you that if you looked at my trade history for the last 5 years, 10 pip, 10 pip, 10 pip, 10 pip, 10 pip, 10, 10, 10, 10, right? Some 50s every once in a while, like seldomly, maybe 0.5% of all my trades in my whole trading career have been either 10 pip or 50 pip. That's it, because I know how and why I get a 10 pip 96% of the time. Why would I do anything different? I've gotten wealthy on that. There are people that give their left arm to do that, just a 10 pip trade. If the idea is to grow wealth, is to become wealthy, is to have something consistent, then do that. If it's to get rich overnight, you're in the wrong place. Go rob a bank, sell crack. I don't know. You know, you're just not going to do it in trading. You're not. If you did, think about what you'd have to do to get that, right? You'd have to lay it all on black, let the roulette table spin, and hope that it lands on your color. That's it. And then what happens then? You get $100,000. You go and cash out your 401k, you whatever, right? You take $100,000, you put it in the market, you go long. I don't know why you're just kind of rolling with it. I'm going to go along. I'm just going to trail that sucker till kingdom come. See what happens, right? What happens if you win? Let's say you win. Say you get 1,000 pips, right? So you got all these dollars, right? Then what? That's what would happen, right? So instead, what do? You either quit, right? Or you do it again and you lose. It's not a recipe for success, for long-term success. So the only way you get to that level is by putting in the due diligence. There's no shortcuts. There's just no shortcuts. And if you haven't done it and you feel like you're already too bought and invested in what you're doing, well, then you're an old dog and can't teach you new tricks. If you're willing to shake that off and say, okay, I have an approach. This is what I understand of the indicators. Make sure it's systematic if you can't read them fluidly. If you're not being successful at what you're doing right now, here's your sign. You can't read them fluidly if that's what you're trying to do. If you aren't reading them fluidly and you have a very systematic approach saying, when these things are present, I execute and I get this much and you're still losing, it's probably because your exit method, right? You're not justifying the risk to reward. So it's very simple to go back and say, okay, if I hit this, say 80% of the time and I had a stop loss that was 3 times greater than my gain, could I still hit that 80% of the time? You back test, you find that it's true. Perfect. You have your systematic approach. So now you can go into the market and use just that, right? And then you learn something else from someone else. Orange Crush from Jason Hall or whatever it may be, right? And you back test it for the times that you trade and you do the same thing. So it's just rinse and repeat, right? Now you've got 2 things, right? Now you're executing with 2 things, maybe on 3 different currency pairs. You've now branched out. Now, by the way, to branch out to a different currency pair, you got to do the same thing. You got to back test it because every currency pair is different. you might find that the GJ will give you 3 times as much as the EU, right? The Euro USD might be able to go for a 5 pip trade on dirty pressure for the times that you trade. But on the GBP JPY, you could go for 15 pips with the same stop loss. Right, so now you have a 1-to-1 traded at 80 to 85% accuracy. We already said it from 2018, January 2018 to current with dirty pressure for 1300, 1400, 1500, 3, 4, and 5 hours UTC is 93.8%. Somebody's already done the work for you. So if you can trade at those times and you see a dirty pressure signal, you know that its accuracy is what? 93.8. So let's just say 90%. So you know it's 90%. With 90%, you can justify a 4-to-1, which means a 20 pip stop loss with a 5 pip take profit. But it was tested at 93.8 for a 5 pip take profit and a 15 pip stop loss, which is a 3-to-1. You already have something. You already have something in your pocket that you can go into the market. And I can go and back test it on Euro USD, GBP JPY, and GBP USD. You can get at least 5 to 7 of those a day, spread across 24-hour period. Out of 5 to 7 with a 90+% accuracy with just those 6 time frames, can you get 2 of those a day? Can you just get 2 of them? That's 10 pips. Can you get 1% growth and only risk 2% max per trade? So there's your 2-to-1 risk, right? You're risking 2% to get 1% growth. So if you grew 1% a day on 10 pips with a 3-to-1 at a 90% accuracy, right? If you do the math, I want you guys to do the math. You'll double an account every 4.5 to 5 months. I'm not making it up. Go do the math. Go, and when you do it real. Take the examples, right? Right here is where I would increase my lot size. Okay, right here is where I would set my lot size back. That's the only real true way to do it. You can't just take the numbers aggregately and at the end figure it out, right? Because you don't know where your losers and winners are going to be. So again, what is that? The burden of proof lies on you. Well, actually, it lies on me, but I've got it. Now you got to prove it to yourself. All right. So the only way you do that is by doing the work. I can tell you that. You have to trust me. Right? Most of you guys don't know who's matter. You just know who's hire him on Wednesday nights. That's it. You guys don't know. Maybe I'm the biggest liar on the face of the planet, right? But the way you figure it out so that you give yourself the psychological boost that you need is to go and test it yourself to figure it out. Yes, sir.
What was the name of that strategy that you just described in your fishing game when you talked about like before being a mastermind?
Yeah, no, it's called dirty pressure. I'll show it to you really quickly. So I've got about 4 minutes. So last examples we used for dirty pressure, I think, was just back to 2018, like the first of 2018. Excuse me. So right here, you see how green is on top, and let's look at pressure. I have this one because it's spread out so you can see when green changes positions. Green is currently on top of red, correct? This is the same candle. So right there, green now is on bottom of red. It just arrived there. That looks pretty strong up, right? So all we need is for these lines to point down when that happens. If they are, we sell. We do nothing here because they're not pointed down. Let's go to the next example. All right, green's still on bottom. All right, now green's on top of red, and all 4 of these lines are pointed up. Now, although this is kind of a really common reversal where we'd actually look to short, we know that 60 to 65% of the time it still buys a little bit because we have our dirty pressure, and we know that's performing at about 80 to 85%. We're going to go long right here for at least 5 with a 15 pip stop. That one went 9.3, drawdown 10.7. It's likely we got our profit first, but regardless, it didn't go 15 before it went 5. Green popped on bottom of red. Just happened. All 4 lines are pointed down. Sell for 5. There's 10.4. All right, so right, green popped on top of red. All 4 lines pointed up. What do we do? How many pips? What's our stop loss? Congratulations, you guys made a successful trade. 6.8, even with spread, you covered it. 2.1 drawdown. Let's do one more.
What is the time frame you use?
60 minutes, sir. Good question. Thank you. You can try it on anything. I have data for a 5-minute. I didn't collect it, but it looks sound thus far. All right. Green just popped on bottom of red. What do we need major or minor to do?
Pointing down.
Point down. Are all 4 lines pointed down? What are we doing? 5. What's our stop loss? Our drawdown was 4.2. Our profit was 14 point, or it went 14.7. Did we win? There you go. You guys made 2 successful trades. It took like 2 minutes to show you guys that, right? Simple, easy. The more systematic and simple your approach, the better off you are. Most of us grew our accounts in the simplest, crazy simple things you guys wouldn't even believe. Like just the simplest things, because it's all we understood. It's all we knew. But we mastered it. And we made killer money on it. If you're not to that point, you're overcomplicating it. These indicators work so good. Like if you're not winning, you're overcomplicating, and it's okay. It's a common mistake, right? Because although it's structured like traditional higher education, sometimes we have a hard time connecting those dots. So when you go to college, you have prerequisites, right? Does that have anything to do with you becoming a brain surgeon if you're going to do algebra or creative writing? No, right? But you have to do it. So burden of education lies on us. We teach you everything. It doesn't mean you have to have all of that in order to be a successful trader. It's just on us to teach it to you. So we teach it to you, figure out what makes sense to you with the indicators, and you apply it. The simplest stuff. I'm telling you, I grew my account on double crosses, 3-pointers on the TNTs, and echo patterns, and they were never at the same time, right? It's either had one or the other. And I only started with double crosses. And it wasn't enough, so I had to and I only traded euro versus US dollar. I didn't even trade multiple currency pairs. I wasn't cool like the rest of you guys. And I did that for like 2.5 years, right? It was boring. It's even now it's boring. It's not sexy and fun. It's boring. Where I have fun is back testing and demo trading. I love that stuff because you can do all your theoreticals and you can experience and understand new things. But my trading now is so systematic that these are the things that I look for. If they're there, then I take the trade and I trade at a high win rate and I'm done. If it's not there, I do nothing. That simple, right? The simpler, the better. I promise you. If you got 1,000 charts on here with 1 million different lines, just strip it down. Just what do you understand? Because you may not understand a fraction of those. So I have them there. All right, I'm out of time, guys. I think Kevin's got something to say, if I'm not mistaken. Awesome. So, right? Mr. Jones, ladies and gentlemen. I always tell those guys, like, at some point, Kevin, you got to just be less available, right? You're too important of a dude. And he's just like, I don't know, he just likes to be around.
It does, something that I really enjoy is watching you guys learn these little things because it's something that we really try to get the coaches to pound into your minds is the basics. One of the best analogies that I always use, anybody a basketball fan in here? Tim Duncan.
Mm-hmm.
They call him the big fundamental. Boring crap to watch play, but he's a Hall of Famer, right? And that's what you guys are here for. You're not, like he said, it's not sexy, but you'll make money at the end of the day. That's the goal, right? That's what we want for you guys. So just a couple of things. As promised, the $10 light went away. Well, correction, it's going away in the morning because the developer is getting code changed. So if you have anybody who wants a last minute $10 light, last month's code works till tomorrow morning at like 8 a.m.
Nice.
So
You're gonna send it
and then it's going to go up to $39.99 for this month. So you guys are aware of that. As always, anybody that you bring into the Light program that you refer, friend, family member, and if they move into coaching, we're going to cover a month of your indicator fees for doing that. So we just always want to say thank you and appreciate you guys sharing what we do with those that you're involved with every day. So I just want to give a thank you to Hiram and hope you guys give him a big round of applause. Appreciate you guys being here.
Thank you, Kevin.
I missed this too. Make sure that you guys are tuning into this. The On It, 4 p.m.
Oh, yeah.
No more. Okay. We're doing 8 a.m. for you guys now. Okay.
Mountain.
So 8 a.m. it's going to be the morning impact trade instead. We wanted to mix things up with the new year. As you guys are doing that, we want to make sure that you guys are trading in some times that give you higher volume. So we want to see what you guys thought about having a coach train and trade with you during that time. So if you guys have any questions around that, please let us know. Okay, thank you.
Thanks, Kevin. Appreciate it. For those of you guys that didn't catch all of that, we're not having the honor anymore. We've got the MIT morning impact trade. That's 8 a.m. Mountain Standard Time. So go into the back office and sign up for that. Scott, to your question, just to clarify on dirty pressure, is your entry at the first post where pressure changes position, or you wait to the whole candle to make sure it remains and enters the next post? It's a good question. So right here, let's say that this is the candle. I'm going to replay this chart. And you guys are more than welcome to stay. The session's over, but obviously you don't have to feel like you gotta stay here after. I'm just gonna explain something for these guys online that I didn't get to. So I'm gonna replay this chart, and I'm gonna show where it formed and then where we would actually execute. Because this is actually a really common question. So there's post and there's, let's say for the sake of the conversation, there's post and there's start. The post is where the candle ends. The start is immediately after the candle ends, a new candle starts. So there's a post and a start. So if you're evaluating on the post, you're not evaluating as the new candle begins and grows, you're evaluating at the end of this candle, right? So let me fast forward here. Let's just go 500 times the speed, get to the bottom of this. So right there, we can see that it's now formed, right? Green was on top, now it's on bottom, and major and minor are pointed down. We do nothing for 37 minutes and 15 seconds. So 2, 1, so 11 minutes. Let me slow this down, 10 times the speed. Now that we get towards the end of the hour, 10 minutes and 50 seconds left, we can see that green is on bottom. It's just arrived there. Major and minor are pointed down. So we got our finger on the trigger, and in 9 minutes, we're going to sell for 5 pips. So 8, 7, 6, 5, 4. Let's see. Yep, still there. 3, 2, 1. Okay, minute and 33 seconds. So now we've got, I'm just going to draw a line, obviously, where we enter. So I've got 40, 30, 20, 6 seconds. Let's put this to regular speed. 5. Now I'm just counting down. 4, 3, 2. Close enough. Sell. That's it. So a couple seconds left, and then I executed. I don't care what the indicators look like on the new candle, because look, minors are pointed up. That's the start. This is the post. Green on bottom, major minor pointed down. It is posted that way. The start of the new candle is where I enter. I don't care what the indicators look like at that point, because I'm using the previous post to justify my current trade. Has the MIT trade started? It says starting on the 7th. That's correct, Bill. It starts on the 7th, Monday the 7th. Wade, email us at info@daytradesmart.com to learn how to join the Slack channel. And Happy New Year to the rest of you as well. Thank you. Awesome. Thanks, guys. If you guys have any questions, feel free to email me. For the rest of you guys, if you guys have questions, feel free to approach me after the session. I'm going to go and wrap this up. And you guys have a good evening. We'll see you on Tuesday for the mastermind and next Wednesday for the review. Have a good one.